गुड इवनिंग एवरीवन। कैसे हैं सब? ऑल डूइंग वेल? ट्रांजिटिंग फ्रॉम स्प्रिंग टू समर, right? So give me my energy to start the session. Some good evening greets, replies, reverts. We have come along a long journey. Reached chapter 11, right? Left with only 2 chapters. So how far has the journey been? The journey of auditing and assurance, right? Okay, same here, Pooja. I suppose we are on time, but I can still see many of you have not joined yet. Is it because of the Mosam, the weather, or because of Sunday? Okay, let us devote 2 to 3 minutes to what you all have done till now, and then we'll proceed further with today's topic, Chapter 11, Audit Report. So, okay, let me share with you. Yes. I hope everyone can see the contents, the index of your auditing syllabus. So what you people have done till now is this from your module 1 and module 2. So chapter 1 was nature, objective, and scope of audit. So we did everything, the ABC of audit, right? Or the AUD of audit. So what is audit? What are the objects of audit? What all we have to cover in audit as an auditor? What are the management's responsibilities? Who are those charged with governance? Who comes in the management? The types of audit and who is an independent auditor? Professional skepticism, professional judgment, and a lot more, hell more of terms. That was chapter 1 while we started with audit. Then came chapter 2, audit strategy, audit planning, and audit program. So we started moving towards deeper into audit. How do we strategize? How do we plan for an audit? And the procedural part, the audit program. All the intricacies of each and every term, each and every aspect, right? Then came audit documentation and audit evidence. While we were continuing with our audit, what is documentation, what is its importance, and what are evidences, how to collect evidences, techniques of audited evidence, types of audit evidence, right? We are rendering a service and a very sensitive service of auditing. So audit evidence forms a crucial part of our service. Then we came to the client side. Some features with respect to the client. Risk assessment and internal control. How do we assess various risks? And the strength of what are internal controls, the strength of internal control at the client's place. Then our responsibilities as an auditor with respect to fraud. Then some miscellaneous chapters were there, audit in an automated environment. Then what is audit sampling, a very important technique used in audit, and what are analytical procedures. So module 1, with module 1, you completed the basics of your audit and some techniques of audit. You were practicing before going for audit or before proceeding towards auditing any entity. We need to know the basics. So module 1 was required in module 1 through module 1. You got to know those basics of auditing. Each and every, all the intricacies required while auditing a client or a client firm or a company. Then we come to module 2, we start auditing. We start using the knowledge we gained in all those 8 chapters, the basics, the techniques, the risk assessment procedures, about internal controls and automated environment. We start applying that particular knowledge, the general as well as the particular knowledge, to various kinds of audits. So with module 2, we started chapter 9, audit of items of financial statements, the most common audit. How do you audit the various items of financial statements of the balance sheet, of the profit and loss, the incomes, the expenditures, the expenses, the assets, the liabilities, each and every head. How do you audit the financial statement? So this was a comprehensive task, and it was quite a big chapter, chapter 9, because it formed the ground, it laid the foundation for auditing various other entities. So we started with very simple chapter, audit of items, simple but comprehensive audit of items of financial statements. Then we stepped up a bit higher. We moved to companies, and hence your chapter 10, the company audit. So be it any subject, you have to be very much particular with the sequence you follow. Your brain works according to that particular sequence, and you have to be very much particular about the sequence, starting from ABC to more complex topics. So after applying the knowledge to a basic chapter, audit of items of financial statements, which we have been, the financial statements, the concept we have been doing since our commerce days, +1, +2, graduation, whatever be your case. Now we shift to the more complex version, the company audit. So how do you audit the accounts, the basic other particulars of a company? So this was all about the company audit. The appointment, qualifications, disqualifications, remuneration, rights, duties, each and everything, every aspect covered with a company, the corporate world. After doing all this, we are done with our audit. Then we move to chapter 11, audit report. So an auditor gets an assignment, a work, he has to perform audit. Now the main part is the audit report. How does he prepare his audit report? What are his duties towards audit report? What are the objectives of audit report? What are the various forms of audit report? What is an auditor supposed to write in his audit report? Kind of the practical part as well, which we do as an auditor in our day-to-day life. And then you will be doing chapter 12 and 13, miscellaneous chapters. How do you, after applying your auditing knowledge on the basic chapter 9, then company chapter 10, doing with audit report, and then banks and many other kinds of entities would be covered. So today we start with a chapter of audit report. So I hope you all can see the screen. Is it visible? Okay. So here we go. So what topics are we going to cover as of in this chapter? So the first topic is forming an opinion on the financial statements. This is the basic objective of the auditor. So he was engaged to perform an audit. He performed his audit. Now who has to, the management, the client looks for his opinion. on the financial statements which have been audited by him or her. So the basic objective of the auditor is this particular word is really important. Opinion. It matters the most. It matters the most important part of an audit, the auditor's opinion. This is where the concept of independence, professional skepticism, professional judgment, experience, everything comes on board. The opinion of the auditor. We are professionals. We are paid for this particular opinion. So this is really important. The second part is form of opinion. So what are the various forms of opinion? The audit report. So the layout, the structure of the audit report, what are the constituents of audit report? Then if there is any particular audit report prescribed by any particular law or regulation. So this is a general format as per standards on auditing. 3. The fourth part is, for example, you are carrying out the audit of a banking institution. The law governing the banking institution will lay out a structure of the audit report as well. So there could be different laws which might lay out a different structure of audit report, a layout, a form of audit report as well. So that is also covered. After your common audit report, the independent audit report, there is any audit report prescribed by any other law or regulation. The fifth part, modifications to the opinion in the independent audit. Why is it called independent auditor's report? Anyone? I call it, as far as I'm concerned, I usually call it IAR, Independent Auditor's Report, IAR. So why is it called Independent Audit Report? What is the significance of the term independent? Anyone? Significance of the term independent. Yes, please. Why is it called Independent Auditor's Report? Wake up, guys. I know it's a Sunday evening, but still, you're not supposed to sleep. You're supposed to type and give me the answer. Okay, fine. Oh, I can see one or two answers. Okay. So independence over here reflects upon two particulars, right? Independence of mind. The auditor is free from any bias, any influence. The audit is an independent audit. So that is why it is called an independent audit report. Once we are done with the audit report, yes, good. So once we are done with the audit report, then if we have to make any modifications to our opinion, we have to modify our opinion depending upon the facts and circumstances of a particular case, of a particular engagement. If we have to modify our opinion, then in that case, how do we modify our opinion? And on what basis do we modify our opinion? Then this is something which is very new for you. Emphasis of matter paragraph. Emphasis of matter paragraph. So whatever I'm discussing with you over here, that is just an intro types, right? We are going to cover each and every topic in today's as well as the sessions to come. So emphasis of matter paragraph. When we were students in school, right? So the teacher would make us write, these are the important questions. Or they would say, your science is weak. You should devote more time to science, and you should lay more emphasis on your handwriting, on your retention skills, or your vocabulary. So in the same manner, in the auditor's audit report, there is this emphasis of meta paragraph where the auditor wants to bring it to the attention of the management. He wants to emphasize on whatever is written in that paragraph. So emphasis of meta paragraphs and other meta paragraphs in an independent auditor report. Okay. Then communicating key audit matters in the independent audit report. This is the most recent topic, key audit matters. Very interesting, very important. The key audit matters. So how do you find the key audit matters? What are the key audit matters? And how do you communicate the key audit matters via your audit report? The last is standard 710. Comparative information, corresponding figures, and comparative financial statements. Very easy and quite an easy topic, easily understandable, right? So what we are going to do today, we will be discussing the objective of the auditor, the various forms of opinion, then we'll be discussing about various matters to be considered by the auditor. Now, in the sessions to come, next two sessions, we'll be doing the format, the layout of the audit report, and how do you bring in the various forms of opinion in the audit report, the key audit matters, and SS 710. So today we'll be covering only the basics, some terms, and we'll be just building the ground. We'll be just laying the foundation for this chapter as of today. Okay. So this is the objective of the auditor, as you can see over here. So he has to form an opinion and he has to report this on financial statements, communicating key audit matters, then emphasis of meta paragraph and other paragraphs we've already done. And these are the various types of opinion. We'll be discussing it today itself. Okay, there are some terms which I need to read out with you or want you to read with me before we move ahead with our chapter topic. So these are the terms. The first term is the general purpose financial statements. So whatever financial reporting framework is applicable to you, you are a bank, you are an insurance company, you are a simple company, or you are a proprietorship firm, whatever kind of organization you are, and what kind of financial reporting framework is applicable to you, or a general framework as per the rules of the accounting standards, right? You prepare your financial statements as per the general purpose framework. These are known as general purpose financial statements. The balance sheets, profit and loss, general purpose financial statements. General purpose framework, a financial reporting framework designed to meet the common financial needs of information needs. Okay, so information needs of a wide range of users. So a financial reporting framework, whatever you have been doing, like the horizontal format of the balance sheet and the profit and loss. So any normal kind of framework through which the common financial information needs. So we are here the financial information. The common financial information of every kind of user is met. That is the financial general purpose framework. Applicable to all, universal. Okay. So this financial reporting framework may be a fair presentation framework or a compliance framework. What is the difference? The term fair presentation framework is used to refer to that financial reporting framework which requires compliance with the requirements of the framework. That particular framework lists out the T&C to be followed while preparing financial statements as per its rules. So that is a fair presentation framework. You come to the Banking Act, the Insurance Act, and they lay out their own framework. And it wants every bank and like the Banking Act, the banking framework, it requires every bank to comply with the requirements of their framework. That is a fair presentation framework. So what does a fair presentation framework include? This framework acknowledges explicitly or implicitly that. So explicitly means straightforward, सीधे तौर पे, written, properly written, there is no second thought. And implicitly is assumed, interpreted. From whatever is given, you have assumed from it. You have find your interpretation. It might not be written directly in that framework. So it is covering both. Whether explicitly or implicitly, to achieve fair presentation of the financial statements, it may be necessary for the management to provide disclosures beyond those specifically required by the framework. Beyond those specifically required by the framework. So fair presentation framework acknowledges explicitly or implicitly that to achieve fair presentation, the management might have to disclose certain facts and figures which might not be required by the framework itself. But if required, the management has to do so, either explicitly or implicitly. The second part, we are still with fair presentation framework, acknowledges explicitly that it may be necessary for management to depart from a requirement of the framework to achieve fair presentation of the financial statements. Note, such departures are expected to be necessarily only in extremely rare circumstances. Straight away, you have to do this explicitly. It was required of the management to depart from a requirement of the framework to achieve fair presentation. For example, the framework might want you to disclose all expenses which fall under 10% of the total expenses under one head only. But the management feels that no, we want to acknowledge each and every expense separately. They might take the benchmark as 5%. So it is completely fine. If it is giving more fair presentation, it is completely fine. Or if there are such departures, they are there, we have to comply with those departures. We have to depart just because it is an extremely rare circumstance. A fire in the factory, a natural disaster. These could be some of the examples where you have to depart from the normal accounting provisions or principles to give a fair presentation. So fair presentation framework is all about true and fair view. So general purpose framework gives us fair presentation framework, and now compliance framework. It is that financial reporting framework that requires compliance with the requirements of the framework, but these two are not covered. What we have covered above, these two are not covered, this and this. Just comply with the fair presentation framework. Whatever be the guidelines of that framework, just comply with it. But when we have to do something different, the management needs to disclose, move beyond some disclosures, or we have to depart from that requirement. These should be, when these two are acknowledged, it is a fair presentation framework, because we want our financial statements to be completely transparent and fair. An extreme presentation where the framework requires to comply with the its requirements only, that is called compliance framework. So general purpose framework has a fair presentation framework and compliance framework. So kind of some basic terms. The very interesting part, and quite a recent thing, the UDN, unique document identification number. How many of you know about it? The UDN or the UDIN? I just want to know how many of you know about it, or have you heard about it, read about it? Please let me know. Very interesting concept. Unique document identification number. Yes. When you become a chartered accountant, the law, our institute has been set up under an act of the Parliament, the Chartered Accountants Act. We have been enshrined with some powers, the power of attestation. Our signature carries strong value. Our attestation, our stamp, it carries a lot of value. It means something. When you attest some financial figures, it means something to all the stakeholders, be it the shareholders, be it the interested parties, be it the government, the lenders. All stakeholders rely upon attested documents, attested financial statements. But some mischievous elements of the professional or the social world start misusing it. The power given to chartered accountants is misused somehow by duping by non-chartered accountants. So this was a problem being faced by our professional community, that their stamps, their signatures were being forged on fraudulent documents, and there were no means to verify it. There were no means to verify, rather than just asking the person, the chartered accountant who has signed those documents, communicating with them, which cost huge time to each and everyone. So this was an initiative which was in talks since 2009-11 within the institute, and finally in the year 2019, the whole system, the setup was ready, and our alma mater came up with this unique concept, unique document identification number. What is it? So just a brief view of the history. It was not noticed that financial documents, certificates, Attested. Attested is you put on your stamp, you stamp a paper and you just sign across as a chartered accountant where you are supposed to. So attested by a third person misrepresenting themselves CA members. समाज के वो शरारती तत्व, the mischievous elements in the society, the third persons, they would misrepresent them as chartered accountant members and would stamp the document, sign along it, and yes, okay. And the stakeholders used to believe it. For example, the bank will believe it. Oh, it has been attested by a chartered accountant. It's completely fine. Documents, the figures are true and fair. The person is earning this much of profit. Let's give him loan. Let's sanction him a limit, business limit. To their amuse, they would find later on that the documents were fraudulent. When they tried to connect to the chartered accountant whose signatures were forged on that particular financial document, he would tell the truth that he hasn't signed those documents. They have been forged. And this would lead to a situation of fraud. So the misdeeds, the misuse by these third persons were misleading the authorities and the stakeholders as well. Our institute received a number of complaints of signatures of chartered accountants forged by non-chartered accountants. So our signature carries financial value. You know, an actor's autograph carries emotional value for the fan. But the chartered accountants, I won't call it as an autograph, our signature carries financial value across the nation. So to curb this malpractice, the Professional Development Committee of the ICI implemented UDN, a unique document identification number concept. All certificates were made mandatory with effect from 1st of February 2009. It was being mandatory for all kinds of certificates, not audits yet. In the same year, in the month of July, they were made applicable to the audits as well. Otherwise, in first phase, they were made mandatory for all certificates issued by chartered accountants. So the chartered accountants having full-time certificate of practice have their offices who are into practice. They had to register themselves on the UDIN portal. I'll show you in the next slide how does it look. The UDIN portal, you have to create an account, you have to register over there. And from 1st of February 2019, it became an important part of every chartered accountant who's in practice life. So after that date, if we are issuing any certificate, what we would do, we'd log into the UDIN portal. We'll give the details as asked. We'll choose certificate. And then with the help of an OTP, one-time password received on a registered phone number, we'll get issued a UDIN number, a specific number which will be as per the particular document or the certificate we are issuing. So an auditor is required to mention the UDIN with respect to each audit report as well, being signed by him along with his membership number while signing an audit report. So this is some kind of number which you have to generate from the UDIN portal as a chartered accountant, and you have to write it on the certificate or the audit report which you are issuing to prove its genuinity. You can see on the right side of your screen, this is a certificate or an audit report, whatever it is. In the last, we have written the name of the firm. We are chartered accountants. The firm's number with ICI, the firm's registration number with ICI. Then you have to sign over here. Signatures, the name of the person signing, his designation in the firm, a partner, his membership number, very important, place, date, and last but not the least and the most important, the UDIN. So if we count the number of digits and letters, this is an alphanumeric number. It comes to be 15. Right? This is just an example over here. We'll see over here. This is just an example. We'll see over here. Okay. So this is the portal which I was talking to you, telling you about. This is the portal. So see, this is written generate UDIN. The portal looks like this. Generate UDIN, your details and everything. This is for certificates. This is for reports, tax and GST. This is for other kinds of audits. And you have to give some information, the PAN, the date of audit, and some financial figures, so that they get punched in the system. And this particular number, when searched for, this particular number, UDIN, when searched for on this website, it lays out those details which are there in the certificate. So here you can see in the next picture, authorities, regulators, banks, others. This is verify UDIN. A chartered accountant goes on the US UDIN portal, logs in and generates UDIN. The other stakeholders can verify UDIN from this link on the same portal. They have to give in some details. They have to just give the UDIN number, their details, and the portal will display those figures which the chartered accountant had given while generating the UDIN. If they match with the certificate issued, that proves the genuinity of the certificate. So this is how we could trace the malpractices. So this 15-digit UDIN, the 6 digits are of the membership number, 6 digits go to date, month, year, and system-generated document serial. This is a composition. You need not learn about this. You just need to be well-versed with the knowledge of UDIN, what UDIN is. In the same manner, right? The income tax department has started issuing DIN, DIN, document identification number, because there were some circulars, some notifications from the department which were being circulated in the social media that proved to be fake later on. Assessors were being or they were served with notices which were fake. Fraudsters would send notices to the assessors using the income tax department's name, the same layout, structure, everything. They would forward the signs asking for taxes, penalties, and they'll just scare the hell out of that particular assessee. What wrong has he or she done? So now the income tax department has also started issuing DINs, document identification numbers, on every letter which they issue to the assessee. It's quite a strong measure whereby the genuinity of the documents can be checked and verified. Okay, now comes the term pervasive. What is pervasive? In literal terms, in English sense, if you ask me what does the word pervasive mean, I would say universal. I would say universal, applies to everything, is found everywhere. So how do widespread or universal or general? So how do we use this term in our subject of audit? It is used in the context of misstatements to describe the effects on financial statements of such misstatements or their possible effects on the financial statements if they remain undetected due to an inability to obtain sufficient appropriate audit evidence. right? So pervasive is just a term which is related to the effects of misstatements. If we are unable to detect the misstatements, our inability to obtain sufficient appropriate audit evidence to detect the misstatements, so the results would be pervasive. General, widespread results. If it is a pervasive result in context of misstatements, it will affect the whole financial statements. Or that particular misstatement's effect might be limited to only one ledger, one account, one head. So when a misstatement, we are unable to detect a misstatement, it affects the whole financial statements. That is called pervasive. It is going to be found everywhere like a virus. But if the effect is not pervasive, that means it is just limited to only one part of your financial statements. It is not affecting the whole population, all the financial statements. That is pervasive. So what are pervasive effects? Pervasive effects in auditor's judgment as per the auditor. So pervasive, what are pervasive effects? Pervasive means they are not confined to specific elements, accounts or items of the financial statements. Not confined to specific elements. Elements means purchase, sale, elements of financial statements. Taxes, furniture, elements, accounts, fixed assets, sales account, administrative expenses accounts, or items of financial statements. Right? So element is nature, accounts is specific head, items is the elements falling under those accounts. So they are not specific, they are not particular to these kinds of elements of the financial statements. They are general, affecting the whole financial statements. If, in that case, if they are so confined, represent or could represent a substantial portion of the financial statements, such misstatement is pervasive or will have a pervasive effect if it is representing a substantial portion of the financial statements, a very important part of the financial statements. Cash, sales, fixed assets. So even if it is confined or represent a particular element, account, or item, its nature is such that it is going to affect a substantial portion of your financial statements. Then this particular misstatement, if left undetected, would have a pervasive effect. It would start a chain of further misstatements. Now, in relation to disclosures by the management, pervasive effects are fundamental to users' understanding of the financial statements. So the disclosures should not be misleading or creating confusion such that they create confusion. Disclosures mean to give some additional information, complementary information to the users. They should be complementing the financial figures, the main part of the financial statements, very well. They should not be misleading the financial statement or the users of the financial statements. If it happens, they will have pervasive effects. Pervasive means found everywhere. They'll be just setting up a chain in the whole system of financial statements, and almost the whole set of financial statements would be affected. And again, if they are affected, that means there is no true and fair view. So that is what the term pervasive is. Okay, so this on screen, you can see the various standards of auditing which we need to cover in this chapter. Audit report. So SA 700 revised, it was revised recently. So the first column is the essay, the second column is the name of the essay, and the third column is on what matter does this essay lays provisions, or what matter is being dealt to by this essay, so the scope of this essay. Essay 700, forming an opinion. So the auditor first has to form an opinion, and then he has to report this of his opinion in the audit report. So this essay discusses about the responsibility to form the opinion, and further it lays out the form and content of the auditor's report. So a tailor-made content, a standard format of the audit report. This is essay 700, quite simple. Now we come to essay 705. This is again revised. Modifications to the opinion in the independent auditor's report. So the auditor might come across a situation where he feels that he may not give a generalized opinion, or he might have to modify his opinion. Modify means an opinion different from the standard, different from what it should have been, different from the usual opinion. So then if you modify your opinion, it is called modified opinion. As per the facts and circumstances of the case, we are going to do it today itself. So there are three types of modified opinion: qualified, adverse, disclaimer of opinion. We'll be doing this today. I'll not speak much upon it right now. We'll be doing this today. Then essay 701, communicating key audit matters in the audit report. So again, auditor's responsibility. How does what he considers as key audit matters? What does he communicate, and how does he communicate the form and content of such communication? So key audit matters are basically some observations of the auditor which he wants to bring to the attention of the management and those charged with governance. Basically, those charged with governance. Key audit matters. These are some key observations which I found during the audit, and I suppose you need to pay attention to these particular matters. Then, as we have read, SA 706 again revised, emphasis of matter paragraph and other paragraph in the other meta paragraph in the auditor's report. This is something which is additional communication. When auditor finds it necessary to draw users' attention to a particular matter, then these come into action. The emphasis of matter paragraph and the other matter paragraphs, depending upon the severity of the matter which the auditor wants to discuss, or which the auditor wants to draw their attention on such matters. So this is just a bird's eye view of the essays you have to do in this particular chapter, audit report. So let us move further. Now we start with a chapter that was just some terms, and we have to do what are we going to do in this particular chapter, audit report. Now we start our chapter of audit report. So basically, when we start with anything, a new particular concept, the first question which comes to our mind, ye hai kya? What is it? What is the meaning, definition, whatever you call it? So audit report is what? It is an opinion drawn on the entity's financial statement. So drawn means made, to make sure that the records are true and fair representation of the transactions they claim to represent. So there is management, there are financial statements. It is the responsibility of the management to prepare financial statements. Then the auditor carries out the audit. Now he has to form an opinion. And what is the opinion all about? The opinion is all about that here is the management which says that yes, our financial statements represent true and fair view. As an auditor, I have to verify whether their contention is correct or not. Actually, their financial statements are representing a true or fair view or not, as they claim to represent. They will always claim, oh, completely fine, without any error or mistakes. It is the auditor which has to check thoroughly, test checking, sampling, whatever his procedures be. Whatever he observes, his observations, the results he has reached to, he'll express his opinion in agreement to the claim of the management or against their claim. So this is what audit report is. We all know the management's responsibility is to prepare financial statements. Management has to accept this responsibility because preparation of financial statements, implementation of internal controls, it is the responsibility of the management. Because if internal controls are strong, there are higher chances that their financial statements would be free from any material misstatements, whether due to fraud or error, because strong internal controls don't let this happen. If they are weak, the control risk is high, and therefore to bring the detection risk to on a lower side, the auditor has to work more. I suppose the statement is completely fine with you. You might have done it in your chapter of risk assessment. Inherent risk, control risk, detection risk. They frame the audit risk. Audit risk के अंदर क्या क्या आता है? Control risk, detection risk, inherent risk. Inherent risk is unavoidable. Control risk arises out of weak or strong internal controls. Detection risk is on the part of the auditor. The risk he fails to detect misstatements or material misstatements. So how does the audit report help? We all know the purpose of the audit is to enhance the degree of the confidence of intended users. Who are intended users? In future, who are going to take decisions based upon the financial statements you are auditing. The management prepares the financial statements before giving it to the users, intended users, who will have to take decisions based upon the results of those financial statements. They need to be checked upon by an auditor. An auditor checks it, attests it, and then the users can feel assured that yes, they are true and fair. So how would they know that the financial statements are true and fair? When the auditor comes out with his audit report, properly signed under his signature, and now the newer concept of UDIN. So he gets to know that the statements, the reports is genuine because there is a UDIN number and the auditor has attested it. So, considerations on the part of the auditor. What does the auditor do while carrying out his audit and forming his opinion? The auditor has to consider whether financial statements have been prepared in accordance with the acceptable financial reporting framework as applicable to the entity. I've already told you different framework for banks, from insurance companies, for NBFCs, for electricity companies, different kind of organization, different kind of framework, whatever is applicable to that particular organization. Financial statements should be prepared accordingly. You cannot come out with a horizontal balance sheet in the case of companies. The Companies Act schedules to the Companies Act properly lay down the framework. You have to present the balance sheet, the statement of affairs, the statement of profit and loss of a company as given in our framework, as per the layout given in our framework. You cannot just come up with a horizontal presentation of the financial statement and yes, audit it. No. So acceptable financial reporting framework applicable to the entity under audit. And we also have to take care, as far as the framework is concerned, that the financial statements comply with the relevant statutory requirements as well. Statutory requirements is under the law, they are being audited. So for example, you are conducting the audit of a bank. So it would be governed banking. Banks are banking companies. So banking acts are also applicable and the Companies Act is also applicable. So the financial reporting framework will consider as given by the Banking Act. But we have to take care that the financial statements comply with the statutory requirement of both the laws. If there is a conflict between the Banking Act and the Companies Act, whom would you choose? Okay, quick question. Who would you choose? You are auditing a bank, the financial statements of a bank, and there comes a situation where any situation, let us assume there is a situation where the Banking Act lays a different provisions than the Companies Act. And these two statutes, these two laws govern the financial statements of the particular bank. So whom would you choose as an auditor? What would you see? Would you ask the bank to comply with the requirements of the Companies Act or the Banking Act? I've received just one answer. Please, come on, wake up. Yes, Khushi, right. Yes, but obviously banking, the applicable financial reporting framework. If you are in such a dilemma, you will definitely choose the Banking Acts. So the auditor has to consider that as far as the financial reporting acceptable FRF is concerned, financial reporting framework is concerned, we have to comply with the relevant statutory requirements as well. Who are the users? The auditor has to keep in mind the users of the audit report. Who all are the users? The shareholders, the members, and all other stakeholders. Stakeholders, government for the taxes, for the financial health, bankers, lenders, the financial health of the company. So these are all the users of the audit report. They'll go through the audit report of the auditor to check what has the auditor reported upon. Has the auditor brought something out which requires immediate attention? Yes, Pooja, completely right. Special Act overrides General Act. Okay. So moving ahead, the SA 700, forming an opinion on and reporting on financial statements. So what does this essay tell us? It deals with the auditor's responsibility. So essays are meant to be followed by the auditors. Standards on auditing. Who carries out the auditing work? The auditor. So essays are meant to be followed by the auditors. So it is the auditor's responsibility to form an opinion on the financial statements. And when he's done with forming his opinion, he has to write it down and convey it to the stakeholders, the users, in a legible form, in written form. So what do we require for that? We require the form and content of the auditor's report issued as a result of an audit of financial statements. So this essay tells the auditor about his responsibility to form an opinion. He'll ask, okay, auditor, are you ready with your opinion? Yes, I'm ready. Okay, come up with your opinion. How do I come up with my opinion? Just give me some format. It should not be verbal. हवा में नहीं बोल देना. Okay, the essay says yes. This is the form and content. So this is the form and these are the contents as per which you have to submit your opinion. So 700 first makes the auditor aware of his responsibility and further then gives him the form and content in which he should report to the stakeholders. Okay. So what does this essay require of the auditor? Addressing an appropriate balance between the need for consistency and comparability in auditor reporting globally. These are some general facts which you need to read. Some general facts. What does this essay want the auditor to address? So the auditor should address an appropriate balance between the need for consistency and comparability in auditor reporting globally. So across the globe, many auditors are auditing many entities, the different kind or the same kind of entities, and they would be reporting. So auditors should report in such a manner that there is some consistency in his or her approach and it should be comparable at a global level. Auditor, we need to increase the value of auditor reporting by making the information provided in the auditor report more relevant to the users. That is why the concept of key audit matters was introduced. So we made changes to the audit report and we wanted that the auditor should provide us something extra. The marginal utility got increased. We need something extra from the auditor. While he's giving out his audit report, we need some extra information, which helps us in making our decisions, financial decisions. So auditors reporting got importance and some extra information, some major information was asked for in the audit report relevant to the users. Key audit matters is just an example of that. So this particular essay thrusts upon these things, promotes consistency in the auditor's report and recognizes the need for flexibility to accommodate special circumstances. Because when the audit is conducted in accordance with standards on auditing, it promotes credibility in the global marketplace by making more readily identifiable those audits that have been conducted in accordance with the globally recognized standards. You know, as far as the auditing standards, the accounting standards, the tax standards are concerned, we are going global. You might have read about IFRS, Ind AS, secretarial standards, costing standards. We are not functioning in isolation at present. The world is going virtual. It has turned into a global virtual village. People are moving out of their countries to do business, accounting, and thus auditing has to take care of that as well. So the standards are being revised, being redeveloped on the basis of international requirements, global requirements, to lend more credibility to the audits as well. So if my standard doesn't tell me anything about the foreign exchange related transactions, the transfer pricing transactions, and many other things, many other factors which are considered global, my standards would be outdated. They would find no relevance in present day world, in the world of multinational corporations and multinational firms. So this particular essay helps to promote the user's understanding, the user of the financial statements, understanding and to identify unusual circumstances when they occur. Moving ahead, what are the objectives of the auditor as per SA 700? We have done it to form an opinion on the financial statements. How does the auditor form an opinion? By evaluating the conclusions he has drawn from the audit evidence obtained. You are sitting in the exam, you evaluate what you have done, what you have retained, and then you write the answer. In the same way, the auditor has come a long way during the audit. He has gathered all the audit evidence on the road to conclusion of the audit. Now he has reached some conclusions. Now he has to evaluate those conclusions. So he collects audit evidence, he reaches the conclusions, and now he evaluates all what he has found. Like you revise before appearing for the exam, he evaluates each and everything. What is more significant? And thereby, after that, he expresses clearly his opinion through a written report. So as per SA 700, these are the objectives of the audit. So the step 1, then step 2. This is mistakenly written step 3. We'll change it when I provide you with the notes. Okay. So obtaining reasonable assurance. Now the auditor has come to a conclusion. He's evaluating. Why does he need to evaluate those conclusions? Because auditor needs to be reasonably assured. What is reasonable assurance? What is reasonable assurance? An assurance, an affirmative statement, an affirmative feeling that he can prove with logic, with reasons. Something which is subjective, not like an MCQ. Okay, A, B, C, or D. C, no reasons. It is C. No. Reasonable. It is not absolute assurance. Reasonable assurance. That he can prove with reasons. He has reasons to believe that. So the auditor should, as step 2, he needs to obtain reasonable assurance to find that whether financial statements are prepared in accordance with the applicable financial reporting framework, and whether he has obtained reasonable assurance about whether the financial statements are free from material misstatements due to fraud or error. So why does he need reasonable assurance? He needs reasonable assurance that the financial statements are free from material misstatement due to fraud or error. So what would he take into account while concluding this? He'll have to recollect whether sufficient and appropriate audit evidence has been obtained, sufficient quality, appropriate quantity, relevant audit evidence, sufficient and appropriate audit evidence has been obtained. So what are the uncorrected misstatements that are material individually or in aggregate? So we did this in chapter 2. What are uncorrected misstatements? The misstatements identified during the audit which have not been corrected by the management, the makers of the financial statements. They have not been corrected, whether on a standalone basis or their accumulated effect has any impact on the auditor's conclusions. Further, his evaluations of the same. Evaluations means he has to evaluate, come to a final conclusion. Everything, the positives, the negatives, the pros, cons of every kind of facts and figures he came across during the audit. What could have been wrong? What was the error or the mistake? What could be avoided? What can be ignored? What cannot be ignored? Everything to be evaluated at the last. That is reasonable assurance. So, what would the auditor evaluate? The auditor shall evaluate whether the financial statements are prepared in accordance with the requirements of the applicable FRF, financial reporting framework. This will include consideration of qualitative aspects of the entity's accounting practices. So what are the accounting practices followed by the entity? And if there are any indicators of a possible bias in the management's judgment. What could be the possible management's judgment, bias in management's judgment? No, we will not show the fixed assets at historical cost. We'll show them at replacement cost or as per the present value. That will give a good view to the financial health as on a particular date. The fixed assets will be inflated. Why does the management want to do that? So there are some indicators of possible bias in the management's judgments. Why did they resort to it? Fixed assets got depreciated, but no. They said, "Hum historical cost pe nahi dikhayenge. We will show them on current cost." So if they are doing something, they should be supporting it with a proper reason. Otherwise, this would tantamount to bias, bias by the management. So what does the auditor need to evaluate? Management makes a number of judgments about the amounts and disclosures in the financial statements. The management doesn't want to disclose a particular subsequent event in notes to the financial statements. A major loss, a major fire. This is management's bias in judgment. The amount of compensation the company will be giving to the other party as a result of a case, legal case lost by the company. The management doesn't want to disclose it in the financial statements. Although it is not a part of the previous year, but there will be an outflow of money in the coming year. This fact has to be reported in the financial statements. The management doesn't want to report it, disclose it. So these are the kinds of personal bias. Then you have a particular SA 260. which contains a discussion of qualitative aspects of accounting practices covered in that particular essay. So this particular essay covers the qualitative aspects. So the auditor can be aware of possible bias in the management's judgment. The auditor may conclude that there is lack of neutrality together with uncorrected misstatement, causing to the financial statements to be materially misstated. So they are not true and fair. They are not neutral. Anything which is neutral is true and fair. So lack of neutrality because there is bias involved. And it gets coupled with uncorrected misstatement. Two negatives adding, leading to a higher negative submission. So the financial statements are highly materially misstated. What could be the indicators of lack of neutrality? The selective correction of misstatements brought to management's attention during the audit. We brought 10 misstatements to the management's noticed attention during the audit. They just corrected 6 to 7 out of them. All the remaining 4, they said, no, sir, this cannot be corrected. Let it be as it is. They're not conforming to the accounting practices, but still the management wants to keep it that way only. Management bias. You said you cannot, for example, the auditor says you cannot give managerial remuneration more than this particular amount as per the law. The management says, okay, it's completely fine. We want to give this much amount only to the directors. We don't want to abide by the limit of the law. Bias. They don't want to correct it. The most common place where the management can make bias is the accounting estimates. The best example of estimate is accounting estimates using various formulae. Coming to developing a percentage for provision of depreciation or doubtful debts. So here is where the management plays its part of being biased, and the auditor has to take care of such indicators. This is what he evaluates. We have a special essay on this management's estimates, which is essay 540. So you got cross-reference of 2 essays, essay 260 and essay 540 in this evaluation. This is how you are supposed to be writing your answers in the examination hall as well. Cross-reference of other essays and provisions of the law. Okay. Then after general evaluations, some specific evaluations by the auditor. What are those specific evaluations by the auditor? In particular means specifically, giving more attention to. The auditor shall evaluate whether the financial statements adequately means in required quantum. Whatever information is required, it is there. They adequately disclose the significant accounting policies selected and applied. What accounting policies have been selected by the management while preparing the financial statements, and have they been applied properly or not? The accounting policies selected and applied are consistent with the applicable financial reporting framework and are appropriate. As far as the facts and circumstances of the case are concerned, they should be relevant and appropriate. Consistency is our general accounting assumption. The accounting estimates made by the management are reasonable. The best example of reasonable accounting estimates could be the Corona period, the Corona the lockdown period. So majority of the companies would have revised their accounting estimates for that particular period. Even during the audit of the banks in the last 2 years, we as chartered accountants could see how the estimates got changed. Were they biased? No, they were reasonable. And the reason was the changes in the economic environment just because of the lockdown. Globally, global changes were there. There was boom in some particular industries and depression in majority of the industries. So the accounting estimates made by the management should be reasonable. The information presented in the financial statements should be relevant. Relevant means as per the required nature. It should not be irrelevant, something which is not useful. Reliable, trustworthy, comparable. You can compare it with the information of other firms in the industry, industrial basis, non-industrial basis, global basis, whatever you want, comparable with the previous years of the same firm. And they should be understandable. The language should be, the financial language should be like this, that is understandable by one and all. Specific evaluations by the auditor. The financial statements should provide adequate disclosures to enable the intended users to understand the effect of material transactions and events on the information conveyed in the financial statements. So adequate disclosures. The company bagged a big advertisement contract for the coming year's IPL. The company lost a case to the other party, and the amount involved is huge. This is going to affect the financial statements of the next year. Whether it's a plus or a minus, a good news or a bad news, whatever it is, adequate disclosures should be there with the financial statement so that the intended users can understand their effect as of date and in near future as well. The terminology used in the financial statements, including the title of each financial statement, is appropriate. Appropriate is in required number, quantity. There should not be any confusion. So properly classified under different headings and giving proper terminology. These are some of the specific evaluations by the auditor. So the last part before the break, continuing with our specific evaluations by the auditor. When the financial statements are prepared in accordance with the fair presentation framework, we have done the fair presentation framework and the compliance framework under general purpose framework. When the financial statements are prepared in accordance with the fair presentation framework, okay, the evaluations mentioned till now, they would be there. The general evaluations as well as the specific evaluations. They would be there. The auditor will be making those evaluations. And the third set of evaluations which the auditor will have to make is evaluate whether the financial statements achieve fair presentation or not. And how does the auditor evaluate that? With respect to the overall presentation structure and content of the financial statements. Content is in required quantity, all the information is there. Structure is as per the financial reporting framework, horizontal, vertical, how do you categorize it, and the presentation. Whether the financial statements, including the related notes, represent the underlying transactions and events in a manner that it achieves a fair presentation. So you are reporting something in the notes, disclosing something, they should be representing the underlying transactions. You have received advance booking for the advertisement contract. You are disclosing this fact in the disclosures. So that advance should be the underlying transaction, and even is the receipt of the advance, it should be complemented by the way of this disclosure. This is what fair presentation is. The disclosures or the underlying transactions and events should be there complementing each other. Absence of either would confuse the intended user. The auditor has to play a role over here as well. Okay. So what have we done? Step 1 was objectives. Step 2 was auditor has to obtain reasonable assurance. Step 3 is evaluation by the auditor. General evaluations with respect to the quality of accounting policies, practices, and management's judgment. Specific evaluations, here you have the list of specific evaluations. And in addition to these evaluations, when financial statements are to be prepared in accordance with a fair presentation framework, these 2 extra evaluations by the auditor while forming his opinion and reporting on the financial statements. Now, part A, objective of the auditor, is finished. We'll be moving to a very interesting part of forms of opinion after a break. So till now, if you have any queries, you can put them up in the query session. And after, I suppose, 10 minutes break, we'll be here and we'll finish up with the topic of forms of opinion by the auditor. Let's take a break of 10 minutes. Welcome back, everyone. Okay, so right now, after completing the first part, objective of the auditor, we come to forms of opinion. As an auditor, my opinion matters. I have to put it in a written form and I get paid for it as well. And it does help a lot of intended users in taking their decisions. That is why I say when I am the auditor, I have a powerful role. They're right when they say chartered accountants are partners in nation building, because it is their attestation, it is their opinion on which the whole nation relies. They might not rely upon the financial statements, the unaudited financial statements. They might not rely upon it. When they change their form into audited financial statements, they're acceptable everywhere. So this is the power of a chartered accountant's attestation and his or her opinion. Now coming to the forms of opinion. What are the various forms or kinds of opinion a chartered account, an auditor, the auditor can express in written form in the audit report? So here we have on the right side of the screen, you can see audit opinion. There is this flow chart which says there are two types of audit opinions. The one is unmodified opinion. The second is modified opinion. They are opposite of each other. And further, under the modified opinion, we have qualified opinion, adverse opinion, and disclaimer of opinion. You need to understand the concepts, the meanings of these opinions very well today, because in the next session, you'll be doing audit reports format, contents of audit report, and how audit report changes with every situation. When it is an unmodified opinion, how does the standard audit report include an unmodified opinion? How does the audit report get changed, modified just because of the modified opinion? How is it different in the case of qualified, in the case of adverse, in the case of disclaimer of opinion? Quite interesting. So let's come to the first case, unmodified opinion. Unmodified means clean. Everything is okay, perfect, sab kuch badhiya. The auditor shall express an unmodified opinion when the auditor concludes the auditor has evaluated all his audit evidences and conclusions, and further he has come up to a conclusion that the financial statements are prepared in all material respects. All material respects means as per the financial reporting framework, as per the statutory compliances, right? In all material respects, in accordance with the applicable financial reporting framework. Material respects means all aspects, all considerations which were important and material to be taken care of. So unmodified opinion is the kind of clean opinion, or it is the kind of, I would say, clean opinion, where everything is completely fine. The true and fair view is intact. That is unmodified opinion. Now switching over to, if it is unmodified opinion, what does the modified opinion look like? So here we have modified opinion. So there are two cases and there is an or between them. I hope you all can see the or. So if the auditor concludes that based on the audit evidence obtained, whatever audit evidence he has gathered, obtained, collected, the financial statements as a whole are not free from material misstatement. Khapla hai, there is something fishy. So the auditor concludes that on the basis of audit evidences obtained, his evaluation, the financial statements as a whole are not free from material misstatement. There are still some material misstatements creeping in, influencing, impacting the result of those financial statements. The auditor comes to know that, yes, in this case, is going to give a modified opinion. Now, what kind of modified opinion it is going to be, qualified, adverse, or disclaimer of opinion, depends further on the facts of that particular case and the material misstatements. Had they been free from all kinds of misstatements, the auditor would have issued an unmodified opinion. But since he finds, he evaluates, he concludes that the financial statements as a whole are not free from material misstatement. I suppose you all know the difference between misstatement and material misstatement. We covered it in chapter 2, chapter 6 as well. What is material misstatement and what is misstatement simple? Uncorrected misstatement as well. Or the auditor is unable to obtain sufficient appropriate audit evidence to conclude that the financial statements as a whole are free from material misstatement. So he has got every evidence and he concludes that the financial statements are not free from material misstatement. There are material misstatements. Or the second case, whether there are material misstatements or not, still there in the financial statements, he is unable to obtain sufficient appropriate audit evidence with respect to this. Either there are evidences which are not in the required quantity, or which are appropriate but not sufficient, or there are no sufficient appropriate audit evidence based upon which the auditor can reasonably conclude anything. So there are two cases, right? The first case is auditor concludes that there are material misstatements, or the second case is the auditor is unable to obtain sufficient appropriate audit evidence to state in his opinion about the presence or absence of material misstatements in the financial statements as a whole. In these cases, the auditor shall modify his opinion. The auditor shall modify his opinion as per SA 705. Did it in the start in that particular table, all the essays. SA 705 is for modified opinion. Now coming to the types of these modified opinions. So first of all, this is level 1, where there is unmodified and modified. Then further it is level 2, where we have categorized modified into 3 parts, 3 kinds of modified opinion: qualified, adverse, and disclaimer of opinion, and we shall discuss them one by one over here. So just a bird's eye view of the difference between the 3 kinds. The qualified opinion, the auditor having obtained sufficient appropriate audit evidence, he concludes that misstatements are material but not pervasive. Now, the misstatements are material, significant. They are going to affect the financial statements. but they are not pervasive. Pervasive means they are not impacting the financial statements in such a manner that they are present everywhere. It could be a substantial portion. It could be one particular head or element or categorization. So it is material. It will impact the results of the financial statements, but it is limited to some of the accounts, some of the heads, and not present everywhere in the financial statements. Okay. So this is qualified opinion. Adverse opinion. Adverse is now the opinion deteriorates further. The auditor shall express an adverse opinion when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements individually or in the aggregate are both material and pervasive. The misstatements are creating a chain of misstatements. One misstatement is leading to another, further third, and it is a chain which is affecting each and every element account of the financial statements. For example, cash transactions. In the case of qualified opinion, let us take the example of depreciation. You have calculated wrong depreciation. It has affected the balance of fixed assets and the profit credited to revenue and reserves. This is a material misstatement, but it is not affecting any other account. It is just affecting the balance of fixed assets and the reserves. But if there is something which is related to cash, there is some mismanagement relating to cash defalcation. It might be in the revenue, might be in the expenses, expenditure. It can be found everywhere. So it is both material, where the word everywhere is comes into the scene. It is pervasive. So when the misstatements are material, but not pervasive, not affecting all the elements of the financial statements, not present everywhere, it is the auditor will give a qualified opinion. But if the transactions, the misstatements are both material and pervasive, found everywhere in the financial statements, these misstatements, they are just leading one misstatement to another, to third, to fourth, creating a chain just because of one or two misstatements. So in aggregate or individually, they are material and pervasive. So the auditor gives an adverse opinion, and it is more harsh of an opinion than qualified opinion. The next is disclaimer of opinion. What is disclaimer of opinion? The auditor shall disclaim an opinion when he is unable to obtain sufficient appropriate audit evidence and he concludes that the possible effects on the financial statements of undetected misstatements could be both material and pervasive. When you say in Hindi, palla jhad lena. Just stay away from expressing an opinion because there was a situation when you were unable as an auditor to obtain sufficient appropriate audit evidence. If there is not if there is unavailability of sufficient appropriate audit evidence, what would you conclude? What evaluations would you make if there are no audit evidences available? How will you be reasonably assured of any of the facts? You are not in a position to claim any opinion, to give any opinion and claim accordingly that yes, I have given this opinion. I have facts and figures with me. Logically, reasonable assurance. That was the first case. So that was the first case here, modified opinion. So part A is related to qualified and adverse opinion. And part B is related to disclaimer of opinion. Auditor is disclaiming himself. He is not claiming the own opinion. The auditor disclaims, shall disclaim an opinion because he is unable to obtain sufficient appropriate audit evidence, and in the absence of which he cannot come to a conclusion, and he is telling the management, oh, there could be misstatements which could be pervasive and material both. It could be either or both. And usually this happens because of the fault on the part of the management, the client. There could be some limitation on the scope of the auditor. He might not have been provided with the right situation, right cooperation, documents, because he needs the client's assistance. The documents need to be provided by the client only. The auditor cannot create his or her own documents, information. This all has to be made available by the client, by the management. That forms the basis of his audit evidence. If he's not having audit evidence with him, that means there was non-cooperation, or there could be some circumstances where there was limitation on his scope. The auditor was not allowed to enter the server room. The auditor was not allowed to function after the working hours, after the close of the office hours. There were some limitations on auditor's work, auditor's scope, due to which he says, I cannot claim on my opinion. I give disclaimer of opinion. There could be misstatements. They could either be material or pervasive, or material and pervasive, both. It could fall into either category, qualified opinion or adverse opinion. But I cannot, as of now, I cannot claim any opinion. That is disclaimer of opinion. Let us take it one by one. Yes, auditor will give reason, Pooja. वो reason देगा. That is the example I gave you. There is a limitation on his scope. Auditor was not allowed to interview the lower management. The top management made him sit in his room, their room, and all the documents were provided to him, the auditor over there only. The auditor was not allowed to interview the staff. External confirmations were not provided with the auditor. So there could be many reasons under which he might feel pressurized, or he might feel that he's helpless. In that particular case, he'll definitely give his reason. That why is he disclaiming the opinion? So we come to the first part, the qualified opinion, right? So the auditor shall express a qualified opinion when the auditor, having obtained sufficient appropriate audit evidence, concludes that misstatements individually, each misstatement in itself or in aggregate, are material, important, significant, affecting the true and fair view, but not pervasive to the financial statements as a whole. Right? So he'll give a qualified opinion. The second case, material but not pervasive. You can see on the image used over here in the case of qualified opinion, it is written material, the tag of material and a tag of not pervasive. These are the two considerations which you need to take care of in the case of a qualified opinion. I hope you can all see on the left, top left of the screen, qualified opinion, material and not pervasive. Now, this was a straightforward case of qualified opinion. Now we come to the case of disclaimer of opinion. So when he disclaims his opinion, there could be something which makes him realize that this particular case could fall under qualified or adverse opinion. So the auditor is unable to obtain sufficient appropriate audit evidence. So he cannot obtain sufficient appropriate audit evidence on which he can base his opinion. But the auditor concludes that the possible effects on the financial statements of undetected misstatements. We are using the term undetected. Why undetected? Because we might not have been able to detect these misstatements in the absence of sufficient appropriate audit evidence. As an auditor, I have been able to obtain sufficient appropriate audit evidence. And I feel whatever misstatements are there, they are material but not pervasive. Qualified opinion. I have not been able to obtain sufficient appropriate audit evidence, but I can conclude somehow that the undetected misstatements could be material but not pervasive. They could be material but not pervasive. In that case, I'll move towards qualified opinion. If I cannot conclude anything, materiality, pervasiveness, I'll just disclaim my opinion. But even in the case of disclaiming an opinion, further I can conclude about the materiality and pervasiveness of the undetected misstatements. My opinion will fall accordingly under qualified or adverse. And I have to give reasoning for that as well. I have to mention this fact as an auditor. How am I able to conclude that in the absence of sufficient appropriate audit evidence? There is an example. Super Duper Limited is a company engaged in the manufacture of office furniture. Messrs. Young, Old and Associates are the statutory auditors of the company for the financial year 2021 or 21-22, whatever be the case. During the year under audit, the engagement partner, CA Young, noticed that the company has not bifurcated its loan. Bifurcated means categorize separately, divide its loans into long-term and short-term. What are the long-term loans and what are the short-term loans? In the loans and advances category, they have written the consolidated amount. They have not been bifurcated properly, long-term and short-term. CA Young understands that such misstatement is not pervasive, but it is material. So it is there in under the, it is not like an infection which is spreading to the whole body of the financial statements. It is there only, right? Like I get a cut on my finger. If I get septic, the infection will spread to whole body. But if I take it, its care over here only, okay, I'll give qualified opinion. Pervasive means I'm not letting it spread to the whole body. I've kept it over here only, taking care over here, applying medicine and everything. It is material. If I don't take its care over here, it might spread to the whole body. A wound over my finger. But if there is some serious infection which can spread, which is spreading in my whole body, that is pervasive. So no bifurcation of loans into short and long term is like the cut on the finger. It is limited to the advances section only. It is material, but it is not pervasive. It is not affecting the financial statements as a whole. So CA Young understands that. So here, Messrs. Young and Old and Associates shall give a qualified opinion as the effect of the misstatement on account of the known bifurcation of loans into long-term and short-term loans is material but not pervasive. Now, we have to take care of that. We have to understand what is material and what is pervasive, where they are both present. If there is something, the misstatement is pervasive, it will fall into adversity. So this was a case of qualified opinion. Okay, I hope it is clear with this example. Let's move to adverse opinion. Okay, adverse opinion we have already done. The auditor, having obtained sufficient appropriate audit evidence, concludes that the misstatements, either individually or in aggregate, are both material and pervasive, like an infection, spreading to the whole body, spreading to the whole financial statements. I gave you the example of cash as well. Material and pervasive. Again, look at the top left of your screen. Material, pervasive, both taken care of. SA 705 Puja. Let us take an example. Messrs. Taj, Raj and Associates are the statutory auditors of Polex Limited, engaged in the manufacture of premium watches for the financial year 2021. During the course of audit, CA Taj, the engagement partner, found that the stocks and debtors of the company, constituting about 80% of the total assets of the company. The stocks and debtors constitute 80% of the total assets, are not realizable. Huh? Not realizable? How are they current if they are not realizable? Further, kahani abhi baki hai. The cashier of the company has committed a fraud during the year under audit. Both the facts are not reflected in the financial statements for the year ending 31/3/21. See, 80% of the stocks and debtors make up 80% of the assets, and they're not realizable. The layman would say, "Baki 20% ka kya karenge?" When the 80% is not enough, financial health is poor. It is just in the books. It is not realizable, cannot be converted into cash easily. Further, whatever cash they were having, the 20%, the cashier committed a fraud with that cash. So accordingly, CA Taj is of the view that the impact of both the situations on the financial statements is material and pervasive, and thus the financial statements represent a distorted means untrue and unfair, distorted view of the state of affairs of the company. So the auditor, in this particular example, we see that auditor shall express an adverse opinion when he has sufficient appropriate audit evidence that, and he concludes that the misstatements individually or in aggregate are both material and pervasive. So in the case of Polex Limited, CA Taj has found that the stocks and debtors of the constituting about 80% are not realizable. If he has found, he has evidence as well. Further, cashier of the company has committed fraud. Again, he has audit evidence. Such situations are not reflected in the financial statements of the company, despite having a material and pervasive impact on the financial statements. So, Taj should give adverse opinion because this is going to affect the whole financial statements, the cash part. If they are constituting 80% of the whole assets, they are constituting 80% of the whole balance sheet. And if they are not realizable, how can the intended users, what can they rely upon? So this is both material as well as pervasive. Further, CA has to consider the reporting responsibilities under CARO 2020 and Section 143.12 of the Companies Act 2013 as well. So here is a tip for you. While writing your answers in the examination hall, we are under anxiety, we are anxious, and we are under stress and pressure. So like, take it as a question. So when this question comes, we think of, yes, opinion, what kind of opinion and all that. We just answer about adverse opinion only. But see, as an auditor, you have to take every view under consideration. Just don't limit yourself to what has been specifically asked in the question in this type of cases. You're telling them about adverse opinion, also tell them in one line, like over here. Further, even if not us, Taj should also consider reporting responsibilities under CARO 2020 as well as this particular section of the Companies Act. This is where you get marks. This is where you get good marks. Otherwise, they asked about the opinion, you told them about the opinion. Now, if this is a 4 marks or 3 marks question, don't go after writing about all this. What does CARO say? What does this section say? If not asked, you will not have to detail about them, but at least mention them in your answer. This is what good writing is, professional writing is, technical writing. When you have explained your answer as per the question's requirement, and you also give a food for thought, that also the CA has to consider the reporting responsibilities under CARO and section. So we are telling the examiner, we know that there are requirements under CARO as well, this particular section of the Companies Act as well. But since we have not asked that in question, we are not going to answer that in detail. But we are telling you, we know about it. There would be some additional reporting requirements as well, clubbing with the adverse opinion. This is the strength of a beautiful answer where you get marks, good marks. So this is just a tip for you from examination point of view. Now coming to disclaimer of opinion. When would the auditor shall disclaim an opinion? You can see on the top left of your screen, there is this auditor standing and it says, we do not express any opinion. We do not express an opinion. So that is disclaimer of opinion. The auditor is unable. So in the previous cases, in the case of adverse and qualified, the auditor he was perfectly able to collect sufficient appropriate audit evidence. But in this case, the auditor is unable to obtain sufficient appropriate audit evidence on which to base his opinion. And the auditor concludes that the possible effects on the financial statements of the undetected misstatements, if any, could be both material and pervasive. So the important part is could be. Oh, okay, it's completely fine. It's completely fine. We'll get the notes. You'll get it. So the important part is could be. Right? In extremely rare circumstances involving multiple uncertainties, the auditor concludes. So there are 2 cases. Auditor is unable to obtain sufficient appropriate audit evidence, and he finds that there could be both materiality and pervasiveness. And in extremely rare, quite low probability circumstances, the auditor concludes that notwithstanding having obtained sufficient appropriate audit evidence regarding each of the individual uncertainties, it is not possible to form an opinion. So not possible to form an opinion on the financial statements due to the potential interaction of the uncertainties and their possible cumulative effect on the financial statement. So this is an extremely rare circumstance where there are multiple uncertainties involved. And the auditor says notwithstanding मतलब what does it mean? Side पे रखते हुए, जो आगे कहा जा रहा है उसको side पे रखते हुए, whatever is being told after notwithstanding, to keep it aside. So notwithstanding having obtained sufficient appropriate audit evidence. Although the auditor has obtained sufficient appropriate audit evidence, but they are not enough in the case of these multiple uncertainties, because these uncertainties, a case going on, you might lose, you might win. You have filed a tender for a very big contract. You might get the contract, you might not get the contract. There are many kind of such uncertainties where their cumulative potential interaction on the financial statements would render you helpless, will not be able to form an audit opinion. This is extremely rare circumstance. So these are the two cases where the auditor would disclaim his opinion. Example. So we have an example. Delightful Limited is a company engaged in the production of smiley balls. During the financial year 2021, the company transferred its accounts to SAP system, accounting and auditing in an automated environment, SAP system, from manual system of accounts. Since the employees of the company were not well versed with the SAP system, there were many errors in the accounting during the transition period. This happened in the year 2013, when the banking world in India moved from their old software to the CBS system, core banking solution, centralized server system. This was a major problem at that time in the history, 2013 year. As such, the statutory auditors of the company were not able to extract correct data and reports from the system because they have shifted from manual to computerized system SAP, and the employees are not fully trained as of yet, and there were some accounting errors during this transition period. Therefore, statutory auditors were not able to extract correct data and reports from the system. Such data was not available manually also. So I'll tell you one example. When we go on bank audits, with respect to the scrutiny of various sample accounts, when we ask the bank manager, okay, we want the statement of this particular account since inception. Since this account started, we want the statement from that particular time. So they'll come up with a reason. सर 2013 से ही अवेलेबल है, तब हमारा सिस्टम मैनुअली से हमारा पुराने सिस्टम से नए सिस्टम पे शिफ्ट हुआ था, तो कंप्यूटर में तो हमें 2013 से मिलेगा, उसके पहले की स्टेटमेंट्स हम आपको फाइल से दे देते हैं if you insist. We'll give you the statements before 2013 from the file in physical format, but in our system, we'll be able to print the account statements from the year 2013 till date. So the data was not available. Sometimes the data is not available manually as well in the files. Further, the employees and the management of the company were not supportive in providing the requisite information to the audit team. They were themselves irritated and frustrated with the transition. They were not ready to cooperate and support the audit team. So what kind of audit report in this the statutory auditor would give? So here, look, what is available to audit? Clearly visible that the auditor is unable to obtain sufficient and appropriate audit evidence. Obviously, he will give disclaimer of opinion as per SA 705. Because in the present case, he is unable to extract correct data and reports from the SAP system for conduct of audit. And also they were not available manually. What has he got with him as an audience, as an evidence? Nothing. As such, he will give a disclaimer of opinion. This is what disclaimer of opinion is. So, which type of opinion is appropriate under which circumstances? So, which type of modified opinion? Adverse, qualification, disclaimer. How do you find what is the most appropriate? The nature of the matter giving rise to the modification is whether the financial statements are materially misstated, or in the case of an inability to obtain sufficient appropriate audit evidence, may be materially misstated. So you have an audit evidence that the financial statements are materially misstated, or in the absence of audit evidence as well, you can conclude that they may be materially misstated. So here it is are, they are, we have concluded they are. Where we are not able to conclude, we say there may be material misstatements. So as per the facts and circumstances of the case, which type of opinion is appropriate? If you find they are materially misstated, they could be materially misstated. Further, other factor, we have seen this, auditor's judgment about the pervasiveness of the effects of the possible effects. So two factors are there. First is material misstatement. If you have audit evidence with respect to the misstatement being material, it will fall under adverse or qualified, right? Or in the case of inability to obtain sufficient appropriate audit evidence, maybe disclaimer of opinion. The first part, on the basis of material misstatement, it says it could be qualified or adverse. In the case of R, it could be qualified or adverse. In the case of may, it is disclaimer of opinion. Now further, out of qualified and adverse, it is auditor's judgment about pervasiveness. On the basis of pervasiveness, he'll conclude whether he has to give qualified opinion or adverse opinion. So here is this matrix for you people. Which type of opinion is appropriate? This matrix is really helpful. Financial statements are materially misstated. Let us come to the first box. This box. Financial statements are materially misstated. Material but not pervasive, qualified opinion. Financial statements are materially misstated. We have come up with the fact. Point number one. Point number two, material and pervasive, adverse opinion. Inability to obtain sufficient appropriate audit evidence. We are unable to obtain sufficient appropriate audit evidence. But we can say that there are misstatements which could be material, may be material. We will give qualified opinion. But when we cannot say there could be material and pervasive, if they are material but not pervasive, we may guess we'll give qualified opinion. But about material and pervasive, we are not sure. Whether they are pervasive as well, we will give disclaimer of opinion. So this is the matrix which is really important, which will help you out in various circumstances as to what opinion should an auditor give. So quite beautiful and helpful matrix. Last part of the day. So there is limitation on the scope of the auditor. There is limitation on the scope of the auditor. If the auditor is unable to obtain sufficient appropriate audit evidence, the auditor shall determine the implications. Determine the implications as follows. First implication, if the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, due to the paucity of the audit evidences, if the possible effect of any undetected misstatement could be material but not pervasive, he will qualify his opinion. He can easily conclude that in the absence of sufficient appropriate audit evidence, the effect could be material but not pervasive, he will qualify the opinion. But if he is unable to tell whether it could be material or pervasive or both, he'll give disclaimer of opinion, as we have done in the previous matrix. I'm sorry, I skipped one slide. Just be with me. I skipped one slide. Okay. So the topic says consequence of inability to obtain sufficient appropriate audit evidence due to a management imposed limitation after the auditor has accepted the engagement. The auditor has accepted the engagement. Now the management imposes a limitation on his scope. If after accepting the engagement, the auditor becomes aware that management has imposed a limitation on the scope of audit that the auditor considers is likely to result in the need to express a qualified opinion or to disclaim an opinion on the financial statements, the auditor shall request the management to remove such limitation. So after accepting the engagement, the auditor is starting with his audit, he is doing his audit, and suddenly the management imposes some limitation. Due to that limitation, the auditor feels that it could affect his collection of sufficient appropriate audit evidence, and he might have to express a qualified opinion or he should disclaim his opinion. So he'll ask the management, please remove this limitation, let me do my work accordingly. If the management refuses to remove the limitation, the auditor shall communicate the matter to those charged with governance. Unless all those charged with governance are involved in managing the entity. So if the people are different in the management as different from those charged with governance, he'll communicate with those charged with governance. But if they're same or more or less the same people, so auditor will think of performing alternative procedures to obtain sufficient appropriate audit evidence. इधर से रास्ता बंद कर दिया, मैं दूसरे रास्ते से जाके देखता हूं. Right? One door is closed, the auditor will find another door. Alternative procedures. Again, if the auditor, through other procedures, alternative procedures as well, is not able to obtain sufficient appropriate audit evidence, so again, he'll qualify the opinion. Or if he concludes that the possible effects on the financial statements of undetected misstatements, if any, could be both material and pervasive. In the absence of audit evidence, he feels that the effect could be material but not pervasive, he will give qualified opinion. In the absence of sufficient appropriate audit evidence, if he feels that the effect could be both material and pervasive, so a qualification of the opinion would be inadequate to communicate the gravity of the situation. So either he will withdraw from the audit, if possible under the applicable law. If he cannot withdraw at this point of time from that engagement, he has to issue his audit report. He will disclaim his opinion. He would disclaim his opinion. Okay. So these are the two important points. Material but not pervasive. He concludes in the absence of sufficient appropriate audit evidence, qualify the opinion. But if he concludes that it could be both material and pervasive, the effect of material misstatements, he'll withdraw from the engagement. If possible, if he is not able to withdraw from the engagement, he would disclaim his opinion. If the auditor withdraws, as per point number 1, before withdrawing, the auditor shall communicate to those charged with governance any matters regarding misstatements identified during the audit that would have given rise to a modification of the plan. He would give justification that I am withdrawing from over here. These are the misstatements which I have identified during the audit, and they might lead me to modify my opinion, either remove the limitation on my scope, or I am withdrawing. If the law is not permitting me to withdraw under the law where I am conducting the audit, I'll disclaim my opinion. So this is what limitation on scope does. So let us do this, the limitation on scope. Just give me a sec. Okay, the limitation on scope we will do. I hope you can all see my screen, a bird's eye view of limitation on scope. So the auditor is unable to obtain sufficient appropriate audit evidence due to a management imposed limitation after the auditor has accepted. The auditor will find possible effects of such undetected misstatements in the absence of sufficient appropriate audit evidence. He finds that he concludes that the possible effects could be material but not pervasive. He will give a qualified opinion. But if he concludes that the possible effects could be material and pervasive, the situation is quite grave, serious situation. He will either withdraw from the audit engagement. If he withdraws, if he is allowed to withdraw under the law, under the terms and conditions of the engagement, he will give those charged with governance, communicate them the misstatements found during the audit and how they could have led him to modify his opinion. If he cannot withdraw from the audit engagement somehow, he will disclaim his opinion, give a disclaimer of opinion. So this is a bird's eye view of what we did. Limitation on the scope of the auditor by the management. I hope it is clear. And please, if you get to another tip, these charts should be handy, right? When you are writing the answers in the examination hall, they cannot substantiate your main answer. You have to write your answer. Suppose you get a situation like this as a question or as a case in your audit exam. So you cannot just draw this chart and give your answer. You are supposed to write professionally. So you have to write your answer professionally in writing, in running answer. You can use this chart along with. There is a chance that this might give strength to your answer. But you cannot use this chart to substitute your main answer. Please make it a point. Students commit this mistake that they use the chart in place of the main answer and they say, we gave our answer. No, you have to write professionally. You can use this chart as an aid. If you are good with your speed and handwriting, you can use this chart as an aid. This might prove beneficial for you in lending strength to your answer. But don't substitute me a main answer with this one. Okay? I hope everything is clear. This was what we could do today with the basics of the audit report, the forms of audit opinion, the evaluations by the auditor, and some terms. In the next session, the form and the content of the audit report under different laws. How does the audit report vary under unmodified and different kinds of modified opinions? Then the key audit matters and the comparatives, the last essay. in this chapter. So in the next 2 sessions, you will be doing that and completing your chapter. This was all about the basics of audit report as of today. If there are any queries, they are all welcome. Otherwise, we may wind up. Okay, that's fine. We're done for today. Thank you so much for bearing with me. Good night, everyone.